Utilizing good research to know when to buy, hold, or sell a common stock. The hardest decisions investors have to make is when to sell, but it's equally as hard to know when to buy. And researching stocks is not easy, but it doesn't have to be hard if you have the right research behind you.
Hey everyone, we are offering 25% off your first payment when you sign up or upgrade to Premium Annual. This is only valid for new users and upgrades to our Premium Annual product. Use promo code BANKING9 in your checkout to claim this offer.
Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And once again, I'm bringing you a subscriber request. I'm going to call these Analyze Out Loud videos. I have quite a few names on the list here because I've been away for a while. What I'm going to do, instead of trying to go through each of these companies individually and giving you a comprehensive look at them, I'm going to talk to you about how you can use research tools to help you make good and long-term profitable investment decisions. And like anything else, if you have the right tools at your disposal, any job becomes easier. But not just having the right tools is often enough. You also have to know how to use those tools correctly. And even for long-term subscribers, unfortunately, for me, because it bothers me that this is happening, I find that a lot of our subscribers don't know how to use the tool properly, the FastGraph research tool. It's a great tool. It can help you do some very, very simple things. I'm going to go through those things as I go through some of these stocks using them as an example. But primarily, I want you to learn how to use the tool to help you make better decisions. So let's start by looking at Adobe Inc. here. Okay, and I'm going to kind of go through the research tool here. I'm going to take weekly closing stock prices off of the graph. And I'm going to take the normal price earnings ratio, which is a market price. It's the PE ratio that the market commonly applies. And I'm going to look at Adobe from a standpoint of its adjusted operating earnings. That's one of the key metrics that we have and that we offer, our subscribers is adjusted operating earnings. Now, it's not GAAP earnings because it's really operating earnings. It's earnings that better reflect how the business is doing. And that's one reason I like to use them so much, okay? But I also have available diluted earnings, which are GAAP, and I can quickly draw the chart there. And you can see there's a difference because these earnings contain accounting convention, one-time non-reoccurring charges, accelerated write-offs, if there was acquisitions or mergers. So it's more about accounting when you're using GAAP earnings and not quite as much focus as the operations of the business. Adjusted operating earnings, as well as some of the other metrics, such as operating cash flows, free cash flows, earnings before interest, taxes, depreciation and amortization, or EBITDA, EBIT, and even sales, will often also give you some very strong insights into the company. But the first thing I want you to notice here when looking at Adobe through some of these different metrics, and actually through all these metrics, you instantly get an impression of what kind of business you're looking at. In Adobe's case, it's a non-dividend paying stock. You can see there's no light green shaded area, no white line. This company doesn't pay a dividend. Okay, but you can also see that the earnings growth has been very strong and very consistent, but I can also see there are times when the earnings have dropped a little bit. Now, here's the trick about using the tool. This is an analytical tool to think with. Okay, you start out with a long-term chart like this. I like to bring weekly closing prices in and look how the market prices the stock, and I can see that I'm using a 17.62 PE ratio. You always have to check the fast facts boxes here to determine what multiple this line represents. This is what I call a valuation reference line. It's a line that says this is approximately what you should be willing to pay for the stock if you were going to, buy it and be able to participate fully in the growth of the company. That kind of helps you get not a guarantee, but an assurance that, you're going to be buying the stock at a fair value so that whatever the business produces, you'll inevitably in the long run be able to participate in. But you also got to recognize that markets misappraise stocks. And as you can see here, the stock got extremely overvalued during this period, starting in about 2014. But I want to make sure you understand this. I always start with a maximum chart. The dynamic nature of FastGraphs is what makes this a very powerful research tool. So I start shortening the graph. Okay, I've got a 17% growth rate which gives me a PE fair value using the P equals growth rate formula of 17.62. If I drop that by a year, now I've only got a 15% growth rate, which means my growth has slowed down a little bit, and I'm only using a PE ratio of 15.41. These are valuation reference lines. They allow you to evaluate how the market should be valuing the stock relative to how it is. The normal PE ratio, which is the blue line, shows you how the market has been on average, and it's a trimmed average, been valuing the stock. And in this case, they've given Adobe a premium valuation of about 32.75 going back to 2006. But once again, this is an analytical tool. The number isn't what's important. It's important to know that that blue line represents that number. And this period here coming out of the recession of 08 and 09 shows that the PE ratios of this company were significantly lower than that, half that, or worse in cases. And there were periods where it was above that, and then it got way above that in 2021, which led to 2022, which was a horrible year for the stock. And yet the company's earnings growth, did quite well, but it did slow down from 28 and 24% down to 10%. Okay, but the growth rate slowed down. Now, I can go through this 1 year at a time, or I can do it in chunks. I can then shorten it to a 15-year graph. Now I've got 16.81% growth. Okay, that's telling me this company is pretty consistent grower at, 15 to say, we'll call it 15 to 20% a year. I shorten this by another 5 years. And so I go ahead and click the 10-year chart here. And now I've got all of a sudden 25% growth. Now the orange line on this graph is using a PE of 25, where when I was using 15, it was using a PE ratio of less than, of 16.81, which was the growth rate. You can find those by pointing to it. So you're using this and you're analyzing. You're just not looking at a picture without knowing how the picture is being drawn. You're trying to really understand what you're seeing here. Now, as growth started to accelerate, the company's PE ratio was very high on average at around 40, but you have to also recognize that the stock now in 2022 reverted to the mean and came down to a 25 PE. So had you bought the stock back here, let's say at 40 times earnings, and you got these marvelous growth rates here that you can see at the bottom of the chart, and held the price to here, you only did 14% capital appreciation, even though the company grew at over 20%. Okay, the point is about valuation is if you buy a stock at fair value, you allow yourself to fully participate in the growth of the company. But you also got to anticipate what that growth is going to be. If I look at going forward on Adobe, if I look at the forecasting calculators on Adobe and go forward, analysts are expecting 13% growth. I could argue that's conservative relative to the last 10 years. I've got 2 years of pure forecast in the current year we're in. So if I want to look at a 5-year graph, I'm going to look at 7 to 8 years here because I'm including the analyst estimates, but I want to see what the 5-year historical, and here it's 21 times earnings. If I go down to that 7 times earnings, I'm looking at 16 times earnings. I'm using the tool. Now, I don't have to think. Okay, this isn't complicated. And some people argue that fast graphs are too complicated. It does all the math for you. You just have to read. You just have to look at the boxes here and decide. And going forward now, I'm looking at an earnings forecast that's significantly lower than these historical norms of 13%. And if I consider that realistic, then, I can then run the numbers through their logical conclusion. And if it traded at a 15 PE, which this type of growth would suggest, I could look at a negative rate of return. Now, I've got not a guarantee that this is going to happen, but I've got an analytical perspective that tells me I would need to be careful buying this stock at these valuations, even after it's corrected as much as it recently has. Okay, so I'm going to handpick some other stocks in this group. These are stocks that you asked to see. I'm going to go ahead and look at Alexandria Real Estate Equities. Now, this is also understanding finance a little bit. Using a REIT, rather than use earnings, which obviously paint kind of a distorted picture, you want to go to funds from operations or adjusted funds from operations, which you'll find under the operating cash flow metrics. Now, once again, I've got a long-term picture of a REIT here. using funds from operation. Remember, REITs have to pay out 90% of their distributable income. So that's why you want to use this kind of quasi cash flow metric here, because you're looking at, what the REIT can deliver to you as a shareholder in terms of dividend income. Now you recognize this is, got a dividend yield of just under 4%. But I also want you to recognize by looking at this graph, I've got a 4% grower. That's all this has grown at. The market has put a pretty high valuation of something around 17, but this is a reference line. Okay, this is 17 times earnings here. The stock was trading at 24 times earnings, 23.7 times funds from operations, not earnings here. But again, if I shorten time frames, if I draw this as a 14-year graph, I now get a 6% growth rate, but it's still just slightly better than the 4 because I've eliminated some of these other years. But keep in mind, by looking at the maximum graph here, I'm getting a real good perspective of how this company has performed. And I'm even getting a good perspective of how it's performed, not just in stock price, which everybody focuses on, but also in operating results coming out of the Great Recession of 2008 and 9. But this is a pretty good, consistent REIT. Coming out of that recession, you could have bought it at a quote-unquote fair value price to FFO. Today, you can buy it at a fair value price to FFO. And if I look at forecasting calculators going forward, a historical 4% grower is expected to grow at 6.43%. But once again, if I look at this from a practical point of view and look at it for, let's say, the last decade or so, I get 6 or 7% growth. And these numbers, although they're different, they're really the same. They're within a reasonable range of each other. Okay, and I see very high valuations, and paying these high valuations looked good for a couple of years, but now that it's corrected back to the reasonable number, I ended up only making 2%. Okay, however, if I'd have bought this stock at a reasonable valuation in the first place, like back here in 2016, and got, roughly 7% growth plus dividend, now my rate of return balloons up to almost 9.84%. Valuation matters, and it matters a lot. And fast graphs helps you make that determination of when the right time to buy, sell, or hold a stock is. Now, these are subscriber requests. I'd love to go through all of them. I don't have time to go through all of them, but I just want you to see by just looking at a fast graph, how instantly you can determine what type of company and what the company's historical results have been. Here's ASML Holding. You can see a pretty consistent grower. The market likes to put a premium valuation. Notice I'm getting no growth rate here because I'm starting out with a negative number. So if I just simply take a couple of years off of that, all of a sudden I get a 20% growth rate, and I got a picture that makes a lot of sense for a lot of the period of time. And I'm going to skip over some of these just very cursory. Here's Baxter International, okay, healthcare equipment. All right, if you look at Baxter, we had nice consistent growth here, but it wasn't at that big a rate back here. I can also use my sliders and come back and look at historical periods of time. And the company, from 2003 to 2014 was growing at about 7.5%, and it went through the Great Recession without missing a beat, if you will. In fact, it had superior earnings growth during that period of time. It raised their dividend, et cetera. But now if I carry this forward, and look at it, going more forward and then max out the graph, I also see that they had a problem in 2014. I might want to know what that was. It also caused them to cut their dividend. But coming out of that, they began growing fast again. And the stock traded at very high valuations before, once again, hitting in a couple of bad years of earnings. So, I'm seeing all that without knowing a whole lot about the inner workings of the company, but yet I know more than a lot of people can know without having the perspective that I get from the fast graphs. Okay, Brinks Company, you can see how the earnings and price relationship works. You can see that it's been a pretty good grower, even though it's been inconsistent at times. Again, draw different time frames, and the growth rates change. You're not manipulating the graph to make the picture fit. What the tool is doing, it's calculating the growth rates and then applying fair value multiples based on what those growth rates were so you can know. But you always want to be looking at the forecasting graphs. And here we're looking at a 19, almost 20% forecast growth rate going forward. Brinks may be a very, very attractive investment right now for those who are looking for a long-term total rate of return. And by the way, the other beauty of fast graphs is you could calculate that by simply pointing to these future times. If this grows at 20% and trades at a 20 PE, you could make 56% a year. If it only traded at 15 PE, you'd make 44% a year. These are what-if scenarios, not guarantees of where the price is going to go, but logical representations of where the price could go based on the operating results that you're looking at as presented. Okay, and you can go through company after company like this and look at them. Then you look at a name like Intel, and you get a really strong perspective here. Intel has been a semi-cyclical quasi-semiconductor company for years, but then it hit a wall in 2022 and 2023, and it's now beginning to recover, and the stock price has fallen dramatically. But the point is, you understand why this happened by looking at the graph. Now, you can go in there and find out specifically why this happened, and you can, by doing further research, which the tool is also designed to give you access to things like the website. If you're a subscriber to some of these other tools like I am, you can go in there and look at Morningstar research. You can look at Zacks research, Seeking Alpha, Wall Street Journal. You can go directly into the company's website and learn more and more about the company. Investing, like Warren Buffett said, investing without research is like playing cards without looking at your cards. I mean, you want to know, what's going on in the companies you're looking at. And you can do that with all these companies. And I'm going to do another video later in the week and cover some more of these stocks here. But you can see great names like Charles Schwab and Company, which has been a semi-cyclical financial, investment banking and brokerage company. But you can see by changing time frames, I'm calculating different growth rates, which give me different perspectives on valuation, which helps me make a more intelligent, rational decision of whether I should be buying, holding, or selling. And I can go to the forecasting graph, and I can look at these companies through a lot of different metrics, and I'm not trying to rely on just one. I'm trying to put all the pieces of this puzzle together so that I can make a good decision as to whether or not I should be buying, selling, or holding a stock. In Charles Schwab's case, I would say it's beginning to look like a buy. Doesn't mean it's the perfect bottom, but it's certainly starting to look like a buy. Anyway, this has been Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. Just trying to give you some insights from stocks that you guys have asked me to look at and try to show you ways that I would look at those stocks strictly through the lens of Fast Graphs. And I did what I like to call Analyze Out Loud videos, just showing you how I can use this tool to learn an awful lot at a glance. We like to say, we produce essential fundamentals at a glance. If you like the video, give me a like, ring the bell, subscribe to the channel, and take a look at subscribing to Fast Graphs. Investing without research is like playing cards without looking at your cards. You need to know what's happening in your portfolios, and Fast Graphs makes it easy. There's nothing complicated about it, and it's also very dynamic. I don't know of any other tool that allows you to run all these different time frames and be able to evaluate whether or not growth is accelerating, decelerating, or staying the same. You can see how cyclical a company is. You can quickly determine if this is the kind of company you're interested in or not. Anyway, thanks for watching. We'll be talking to you again real soon.